Welcome to the Keiser Report. I'm Max Keiser. You know, before the 2004 Indian Ocean tsunami, all creatures with a basic instinct or a sixth sense, able to read the environment in which they lived, had long fled. Elephants screamed and ran for high ground. Monkeys hollered and climbed the trees. Dogs refused to join their owners for the morning swim. Humans, on the other hand, ran out into the receding sea to take photographs of the unusual event, having no frickin' common sense whatsoever about what was about to happen to them. Today we have the same sorry tale to tell. The interest rate tide is receding, and the tsunami of bad debt is about to fall upon us. And yet most market creatures appear to have no instinct for survival. Only a few will survive the debt tsunami. We need Stacy Herbert to break this down and explain it more to us. Stacy Herbert.
Yes, Max. The equivalent of a 9.1 magnitude earthquake has struck in the debt market somewhere, and we see the signs of the receding tide. Is a tsunami about to hit? Yes, I think so. The debt reckoning has arrived. Total debt owed now approaches $60 trillion while Fed wrestles with interest rate confidence game. So, you know, the Fed claimed it's going to taper. Market interest rates went soaring. And now the Fed is backtracking, of course. They're saying, we're not going to taper. We're actually going to print and do whatever you want, markets. But first, I want to look at this chart here. The total debt owed, and the blue is the rising debt load, and the red that stays constantly just rising a little bit in line with inflation every year, year after year, is GDP. Now, the interesting thing, Max, about looking at that chart is, of course, the debt started to depart from GDP once we went off the gold standard. And one of the arguments that the likes of Paul Krugman and Joe Wiesenthal make against the gold standard is that, well, we can't expand the economy. But that chart clearly showed that we haven't been expanding the economy. It's all been fraud, and now that the reckoning is coming.
Yeah, well, a lot of great points there. The economy has been growing a little bit since the 1970s. But when you look at how much debt has been accumulated, it looks quite small, the rate of growth, as compared with the rate of debt growth. The rate of debt growth is unsustainable. That's the tsunami metaphor, that you've got now a crash coming in the bond market, interest rates spiking forward, and all the cost of that interest on the debt explodes in a way that causes enormous economic hardship. Now, another way to look at this, if I can just put this in terms, would be to point out that for every unit of GDP growth we've had over the past few years, 5 years, the units of debt required to create that unit of GDP growth has gone up sharply. So back 30 years ago, it took 1 or 2 units or dollars of debt to create a dollar of GDP growth. Then it got up to $6 or $7 of debt required for just $1 of GDP growth. So it's like a heroin addict. Constantly needs more heroin or more smack, more coke, more drugs, more Oxycontin, like to get the same effect. The same thing with this economy. It's addicted to debt, and now the results, the predictable results, are with us. It's into the gutter it goes.
Now, this other chart shows Fed total assets eliminations from consolidation, and you see that's accelerating. This is the sign of quantitative easing, and there's no sign of tapering. However, because there's been such a violent reaction in the markets to them possibly stopping it, or their allegations of the propaganda that they were stopping it, and I believe that was all about gold, but we'll get to that in a moment. The quick reversal in interest rates signifies a strong reaction by the market. It is fascinating to see how much outside money is now flowing back into the U.S. to purchase stocks, real estate, and other real tangible goods. In other words, global investors are now demanding payment for all that cheap credit lent out. The era of cheap debt is now reversing, and the piper is demanding to be paid.
Right. Reading into that a little bit, in other words, America's hugest creditors, like China, are now demanding assets in exchange for that debt. Remember, 5 or 6 years ago, they tried to buy ConocoPhillips, the oil company, but they said, no, that's a strategic asset. We don't want China to own that. Now, recently, they've been able to buy a huge number of assets, and those assets purchases are growing because they realize that the debt that they hold on their books, because of this secular generational rise in interest rates, is now going to become worth less and less and less. And the way to keep the peace, America is selling to China their income-producing assets, the same way that Greece or Ireland have sold to the Troika or the private equity groups their income-producing assets. It's the same mentality. It's a financial muckraking, marauding that goes on.
Well, also, this whole fiat empire run by the U.S. has always been, the argument always is that we can run this forever because China has nowhere else to spend all the treasury bonds they buy. And that inflation, we can print as much as we want because that inflation will never come back here. Well, this is exactly the scenario where people were projecting when the inflation will happen, is once they start bringing that all those trillions of dollars printed back into the U.S. economy to buy those assets. And it could be one reason why you are seeing booms across America in various mortgage markets, housing markets, and things like that. So in California, for example, 70% of Chinese buyers of property there are paying all cash. So here's that cash from China coming back into the U.S. And will it cause inflation? We'll see.
Well, the U.S. worker gets hit two ways. First, their jobs are outsourced to China over the past 20 years. And now they built up all this cash, and the bond market's reversing, and they're going to bring that cash back to the U.S., and they're pricing people out of being able to afford the homes. So you end up with people homeless and jobless, as they intended.
So that's the debt and fiat market, and we showed you all the signs there that a tsunami in the debt markets is about to hit us. The Asian giant stampeding into gold. While mining production is around 1,134 tons so far this year, gold delivery on the Shanghai Gold Exchange is 918 tons. This is strikingly in contrast to the gold delivery on the COMEX, which stands at only 103 tons year to date at the end of May. So China is consuming every single ounce, every single ton basically produced so far this year, and yet also the fiat dominated markets and commentators in the West focus only on what's happening in the COMEX and what Western investors are doing with their piddly little 103 tons.
Yeah, it's a curious thing, isn't it? During the recent sell-off in gold, the demand for gold in Asia and around the world has skyrocketed to all-time highs. And so when the gold bull market resumes and you see $2,000, $3,000, $5,000 an ounce for gold, most of the gold will be held by Asia, Middle East, and other entities.
And, you know, following on this, Jesse's Cafe Americain writes that CME reports that Brinks has a 70% decline in registered gold bullion supply. And Brinks is now being depleted. They have gone from 447,199 ounces on July 3rd to 134,525 on July 9th, which is a drop of 312,674 ounces. So Jesse, of course, asks, where is the gold going? And he thinks, well, as it's not being reported in other COMEX warehouses, it must be Asia, i.e. all that Shanghai Gold Exchange.
Right, and not only the question is where is the gold going, but where is the gold coming from? So when you see the price of gold drop by 10 or 15% on volume, that would indicate more tons than is mined during the course of 5 or 10 years, then the only conclusion you can come up with is that the central banks are lending the gold out to bullion banks who are then dumping it on the open market, which means that the central banks are short gold, which means that as the price spikes higher, they have to go into the open market to buy gold back. That's the first option. Or B, they've got to get together and completely recalibrate the global currency market, which would only mean doing it against gold, which would make the price of gold go higher also.
Well, in the tsunami, where did all the bodies come from? Where did the tens of thousands of people who died in the tsunami come from? It came from the people who went out looking at this curious event. The same thing here is you've got, where is the gold coming from? It's coming from the weak hands in the West who have all sorts of propagandized, distorted price signals. They don't know how to read the tide going out. They don't know how to read the sudden, wild, violent swing in interest rates. And they think, you know, it's all going to get better. Somehow the quantitative easing is going to continue and they're all going to be fine, while the real gold is shifting east. It could, you know, what's happening there?
Yeah, well, during the 70s, when the price of gold went up 700–800%, it was against a background of rising interest rates. So a lot of people say, well, interest rates are going up. That's a negative for gold. Of course, history doesn't bear that out.
And now, speaking of price signals, however, we have talked over the years, and this is, I think, at the end, if this debt tsunami is coming, this is also the end of these sort of people, and this is share trading volume drops after Reuters changes release schedule. Trading volumes in exchange-traded funds that track the S&P 500 collapsed in the 2-second interval before the release of the Thomson Reuters University of Michigan survey of consumers after Thomson Reuters this week suspended its practice of releasing the data early to clients that paid it several $1,000s a month extra. So if they can't cheat, these high-frequency trading firms are not participating. Only less than 2,000 contracts traded in that 2-second gap, which they used to get previous information early during that time. It used to be tens of thousands of contracts traded. This time, the first time in years that they haven't received the data early, they didn't participate. They didn't want, there was nobody to front run. They didn't have the privileged information, the insider information, so there was no liquidity, no volume.
Goldman shrugged. No inside information, I'm not going to participate. But remember the movie The Sting? It was all based on getting the race results ahead of the actual race results and making bets that were guaranteed to win or lose. Here, Thomson Reuters is telegraphing the results of their market-moving news ahead of when the news is reported so that firms like Goldman Sachs can cheat. Can they make money lying, cheating, stealing? Same thing with J.P. Morgan and others. And so when they closed that window, then they simply walked away from the table and said, well, if we're not going to be able to make money cheating and we don't know how to compete anymore because we've become fat, Twinkie, overfed idiots on Wall Street like Lloyd Blankfein or Jamie Dimon, then we're just going to walk away from the table. Remember Atlas Shrugged, that's the basis of the book. If I can't cheat to make money, I don't want to participate, I don't want to compete because I'm essentially part of a socialist system in America called the Federal Reserve Bank. All right. Well, Stacy Herbert, thank you for explaining that all and on the Keiser Report.
Thank you, Max.
Stay tuned for the second half. A whole lot more. Welcome back to the Keiser Report. I'm Max Keiser. Time now to turn to Jan Scoyles of the Real Asset Company. Jan, welcome back to the Keiser Report.
Thank you for having me.
All right, Jan, let's take a look at the white-hot Chinese gold market. Tell us about your latest report.
We've been doing a series of reports on various exchanges around the world, and we couldn't ignore what was happening in China. You know, I think I've been on, 3 or 4 times now, and every time we go back to China, the huge demand we're seeing in that country. So we decided we'd look at the Shanghai Gold Exchange. We took the 3 most liquid contracts, 2 of which are available for, next day delivery. And in terms of the size of the contracts, they're actually a lot more accessible to sort of the average Joe, as it were.
Why is that?
Well, there's much smaller sizes, so they're 1 kg or 3 kg contracts. And what we found was, which has been reported over the last few weeks, but what we found was that just the huge amount of delivery is being taken off of this exchange, far more than we'd found in our previous research, such as on COMEX. So I think the delivery ratios for COMEX, say, was 5% of contracts being taken delivery of, compared to an average of between 25 and 40% was being taken on the Shanghai Gold Exchange.
So in Shanghai, people are buying gold and they are taking delivery of gold. And they're doing so in big numbers.
Huge numbers. When it's compared to world mine production or even the imports that we're seeing go from Hong Kong to China, it's overtaking or at least reaching those levels on a weekly basis is what we're seeing. So all that physical that's being pumped out of the earth is just making its way to China. How
much, let's say, is flowing? Is it correct to say it's flowing from west to east, the gold market?
Well, I would certainly say, if you're looking at first of all, global production, then it's flowing, nothing's meeting any other demand anywhere else in the world. It's all just going to China. But we've been seeing the rise in imports for a long time from Hong Kong to China. So all of that gold that's going into Hong Kong is just being shipped instantly to China. People are taking delivery of it. I think in the last quarter, imports from China from Hong Kong is up 68%. And last time I was on, the day after we chatted, the gold price fell quite significantly and has fallen again since then. And yet the Chinese just can't get enough of it. Of course, anecdotally, we're hearing stories of these 400-ounce bars are going from the West, being melted down into 1 kg bars in China. That is something we're going to look into, and we haven't looked at it yet. But I don't see how you can deny that there isn't this significant movement from West to East of gold.
All right, let's take a look at some numbers here. It took 4 months for Western investors to sell 271 tons of paper gold on vehicles like GLD, et cetera, but only 2 weeks for the Chinese housewife to buy 300 tons of physical. So Mrs. Wong, as she's being called, is she the new Mrs. Watanabe of the post-fiat world? In other words, during the last 20 years, you heard about Mrs. Watanabe. She's the prototypical Japanese housewife who is swinging the global Forex markets and the yen carry trade and all these things happening. Is there a new Asian housewife driving global Forex and gold, Mrs. Wong? It seems to be what's happening.
Well, yeah, I mean, I think you tweeted a really interesting article a couple of weeks ago. It was a radio show that had been on, and they'd been talking about this kind of the powerful Chinese housewife or the powerful Chinese grandmas who were basically playing Wall Street at their own game. You know, they were a force to be reckoned with when it came to the gold price. Now, whilst we are seeing premiums being reported, these are heavily localized, and in our research, the Shanghai Gold Exchange, which is one that I'm most able to talk about at the moment, is whilst it has got a huge amount of delivery, the volumes that go through are nowhere near as high as we see as the paper gold on COMEX or the OTC market in London. So in terms of the gold price and who's influencing it, at the moment, we're not able to say that China or the Shanghai Gold Exchange are influencing it, but we're definitely seeing a huge disparity between paper gold and physical gold. And I think that if anyone's going to be that wedge that's going to be driven between those two markets, it's going to be those, Chinese housewives, or Mrs. Wong, as you wanted to call her. That's going to be that driving force between the two. So
disparities in these markets are characterized in 2 ways. One is the demand in Asia versus selling in the Western world, and the other disparity is that you've got these huge premiums in gold. In other words, people are paying more than what's called the spot price for gold. And we're seeing those premiums escalate $20, $25 an ounce.
And sorry to interrupt, but not just in China. We're also hearing about Vietnam and India. And of course, they're interesting because there are 2 countries that have featured heavily in the last year or so in terms of governments trying to clamp down on gold demand.
Now, let me interrupt you for a second.
Sorry.
Okay, Argentina has been reported, I just saw something across the tape, that people are paying $1,900 an ounce for gold. Almost $2,000 an ounce for gold, all-time high price for gold. Have you seen that?
Well, I've certainly, again, I hear these things anecdotally and I haven't looked at it, but what we got between the common themes between Argentina, Vietnam and India, just to pull three examples, is that their currencies are not exactly in the strongest position at the moment. And whilst Vietnam and India are clamping down on the gold trade and imports, they're saying it's because this is an empty investment that's not doing anything. They don't see this as this is a currency that they're wanting to hold. This is gold. This is what they want to spend their money in. And so in Argentina, where you've got inflation issues, India, where the rupees are significantly weak, Vietnam, where there's also been huge inflation issues, people want to own gold. And it's not because it's just jewelry and it looks pretty, it's because it's an alternative form of money.
Right. I think it's important to keep in mind that over the past couple hundred years, there's been over 700 fiat currencies that have been created. The average lifespan is about 27 years. Is when the average lifespan of paper money. Gold, however, has still been money for 5,000 years. Let's talk about silver, Jan Scoyles. Any sign that Asian and Indian investors are moving into the silver bullion market?
There's been quite a few interesting reports over the weekend, particularly in the mainstream media, about silver demand in India, which hasn't been as clamped down on as gold imports have been. And it seems like the government is sort of trying to appease jewellery suppliers with silver, and they are seeing significant demand and higher premiums on silver than they were previously. So again, we talk about fiat currencies lasting, 27 years or so. When it hasn't been fiat currencies, it's also been silver. It's not just about gold. So again, we're seeing this push through for silver demand. Silver's also particularly interesting as something you know a lot about and talk a lot about in terms of coin demand. Whereas, the American Mint might have seen a decline in coin demand in the last couple of months. It was phenomenal back in April when we last spoke. And also when we last spoke, we had a conversation about paying VAT on silver. And since then, we've seen a significant significant rise in demand for silver. This is from the Real Asset Company. So again, it's something that people want to hold. It's not just about gold. It's not always just an alternative to gold, although in some parts of Asia where there's issues with gold supply, it is. But people want to hold the two together. And I think this isn't something that should be ignored. And just because it's volatile, people are still wanting to hold on to it and grabbing it whilst it's low.
I want to talk to you about something I read in Eric Sprott's research, Canadian investor in research from Eric Sprott at Sprott Money. He talks about the supply of gold and silver, but in particular gold. There seems to be some anomalies in that you see on the futures exchange and these various other exchanges sales of gold, many hundreds of tons of gold. But it's hard to reconcile where the supply is coming from. He reckons that the central banks themselves are lending the gold to the bullion banks like JP Morgan or HSBC, who in turn are dumping it into the physical market. And then it's being snatched up by Eastern investors. But it leaves these central banks short gold, and the bullion banks like JP Morgan short gold and silver. So that means at some point during a price rise, they're going to have to cover, correct?
Well, this is what everyone's saying, is when does this breaking point occur? Because this discussion of central banks handing over their gold to these larger banks to then sell it, it's been going on for a while, and in a lot of ways, GATA particularly have done a huge amount of work on this. It's sort of...
Is there a breaking point? In other words, can they simply continue to dump paper contracts onto the market ad nauseum without any reconciliation coming? Or is it a foregone conclusion that at some point the gold vigilantes will come in and they'll force some short covering, and then you're going to see some explosive price appreciation? My question is, can they just sell paper gold forever? And a correlation to this question would be, in a rising interest rate environment, doesn't that become next to impossible?
Well, exactly. I think there has to be a breaking point. There can't be, because this demand that we're seeing, particularly in the East, is increasing. We're going to start seeing more people, particularly in Europe, what with the Eurozone at the moment, demanding more gold. So this demand to be taking physical is going to be there. Now, in terms of COMEX and breaking points and gold being dumped and paper being dumped, when we were looking at COMEX, we couldn't find at the moment that there is this breaking point going on, because there isn't a significant amount of delivery being taken from COMEX. So at the moment, no one's particularly worried about what is backing that gold, or if they're going to get their money back from this paper gold. But in time, people are going to have to be asking questions, and this issue about interest rates, which I'm not particularly the person to be talking about this, because there are people that are better qualified to talk about it. But there is this level of anxiety that you can feel rising about what is the price of gold. Is it the price of gold, or is it the gold price? Because now people differentiate between the two. And I think the common man who is suffering is soon going to be bulking together, and they're going to be looking for more alternatives, and they're going to be going, I don't want to be doing any more. My savings aren't going to be making any more money. There is the most populated country in the world seem to know what they're doing with their money. I should be doing that. And I think there is going to become a point where they're going to start asking questions of their central banks, like we see in Germany getting their gold back. Why can't they get their gold back? And I just think all these tiny little pockets of information that we're getting are going to put a lot of pressure on this market.
Yeah, you mentioned Germany. I was going to bring that up. They demanded their gold back from what it's being stored in the U.S. and in other places. And they were told, well, I guess over the next 7 years or something like that, they will try to get their gold back to Germany. Meanwhile, their economy is, for the first time in a while, reporting some contraction, as well as the entire Eurozone. There's a lot of anxiety now in Germany. There's a growing movement in Germany that they want their gold back because they see what's coming. Will the German government be forced to demand their gold in a more obstreperous manner from Americans in light of what is also developing on the macro-political scene, a growing scandal with America spying directly on Germany? Now, Germany claims that this is not a new Stasi, because Angela Merkel says, well, back in the Stasis, we had these huge file cabinets with everyone's files. But I don't think America has those. I don't think she understands the Internet. But once somebody explains to her the Internet, and she realizes that Germans are being spied on 24/7, every single German citizen, is that going to put pressure on this idea, what, we need our gold? And do you see that?
Well, I do, because like you say, there's just this growing level of mistrust, not just from our own governments, but now from other governments, the most powerful government in the world at the moment, the US. And I think the German people have been incredibly influential in getting this gold back. This has all come from a campaign and from other political parties who've been pushing to retrieve this gold. And already, if you see tidbits of quotes from various members of the German government and from the Bundesbank, they've all said there is no reason to be holding that gold abroad.
Unless they don't have it. In other words, they can't deliver it because they don't have it. They sold it, and that's part of the reason why gold's been cheap, because they've been dumping it. Now to get it back, they've got to go into the open market and cause huge problems. Now, Germany may not be able to get their gold back. I think Venezuela got their gold, right? Demanded the gold, right?
Yeah, they did a pretty good job, I think. And what's interesting is now,
next shipment over, they can stick a Snowden in the gold delivery.
Maybe that's a good idea. Maybe someone should give him that hit.
Or did they got all the gold already? He could put him into a gold crate and send him to Venezuela, and nobody would notice because nobody cares about gold.
Well, apparently not. But the Venezuelan people were cheering when Chavez brought it back, weren't they? They were pretty chuffed. And the thing, what's very interesting,
they were pretty chuffed.
They were pretty chuffed.
They were chuffed.
Got their gold back.
You don't hear that every day.
Chuffed.
Yeah, I'm chuffed. Totally. We're out of time, though.
Oh, sorry.
So, Jan Scoyles of the Real Asset Company, thanks so much again for being on the Keiser Report.
Thank you for having me.
All right, and that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I'd like to thank our guest, Jan Scoyles of the Real Asset Company. If you'd like to get in touch, tweet us. Tweet at Keiser Report. Until next time, Max Keiser saying bye, y'all.